Unemployment highlight. So the unemployment comes out, the payroll number comes out. A couple things to understand. It comes out bearish for stocks, minus like 140,000, was supposed to be 50,000, big miss. And generally stocks go down. And we did, but we only went down from like 6 even to like 2 in the S&Ps. When it happens, a big order comes in. Now, this isn't an iceberg or to be read. It's a resting limit order for the world to see. And he was offering 1,000. All right. You can see that here. And so the name of the game is it's a magnet. If they go through it, they generally should stay through it. But it's a little risky to buy it here if it doesn't go. So that's why you have to be on your game when you buy it right through there. You want to see it go, and that's fine. It's just a little bit more risky if you're going to reach that way, and you got to be quick to get out when it doesn't work, and I'll show you why in a second. But in here, we had a chance to buy it on this long down up bar that created a transition and kind of what we call a head fake, which means if that's the consolidation and that's the middle of it, generally it's because you shake out longs and then pop back. You got less longs, less sellers, we can go up. But this was the key, was trying to be long in anticipation for this breakout and follow through. That's important. You got to recognize the order, recognize what it's doing, and then find a location or timing where it's going to go your way sooner rather than later. The definition of a location isn't always price, it's the timing. So when someone asks me if, or I should say, if I put out a survey and I said, you want to be long from 9 or 12, most people in a vacuum would say 9. Of course, it's lower. But it all depends. If you bought it and were long at 9 and it did this the whole time and then finally ran up, but if you bought it at 12, it just went up, you'd rather be long 12s every day of the week, because this is tough to live through. This is going to take its toll on you. And you're going to have all kinds of second guessing in here. And you're going to get shook out and then it goes. So it isn't just price, it's time. Timing, not time like, well, what time are you going to buy it at? No, timing of when you think it could go. Now, it doesn't mean all your trades have to go your way in a half a second. But you want to know that timing creates better location, that the sooner it goes your way, the better, because the less self-doubt it's going to create. So that's the recognition of a big resting sell order. And here's the other things there's a few things that you could stack with this. 6 even, 5 even is where we were right before the number came out. And we call that ground zero, where price is before a big number. Now, it was a big number and it was a big miss to the downside. We break, but not that much. So you could add to the fact that this market's like a beach ball underwater. It can't really stay down on really bearish news. So sure enough, when it got back through where it started, it coincidentally had a big order where it should do that anyway. So you have two things to get people who are leaning short saying this is a bearish number. Why aren't we going down? Well, there's a big 1,000-lot sell order. I'll lean on him. When it goes, they say, oh, and the chase is on. That's the dynamic and the rationale as to why markets and price do what they do. The shorts leaning on that order are chasing it. All right, so that's what we had in that particular instance. We had a similar thing happen here with this iceberg. It was an iceberg and it was a resting order, two big ones. Now we get through it. Take a look at this. We get through it and then stall. And at that moment, and I say this every time that this situation presents itself, it's important not to go back through there, because then this is likely. So like in this instance, it was important to keep driving up, like in here. If you go back down here, then the downside's the right side, because then it just became a head fake and you chased out a bunch of shorts and then you stick longs and they're all looking at each other, staring at each other, waiting for the first guy to run to the exits. This is a situation, and it's all about a little bit of context with, well, where are you at on the map? Here, you're a lot lower on the map in here. So there's just a better chance that it might come back in. But you're not trying to predict it's going to come back in. You're trying to know what to do when it comes back in. Too many times we're trying to create too many predictions instead of diligent reactions, knowing what to look for. So then your prediction becomes more probable because you're reacting to something that you've already trained to see. And instead of just trying to say, I think this is going to happen, I think this is going to happen, wait for something to happen before you say something else is going to happen. Let the dominoes kind of set up. And again, just a perfect scenario is we're bullish unless we get back below it, then look out and be careful long because we're probably bearish. And it's just a probability game. If someone were to say, Anthony, are we going to go back through this red line and we're up here? You know, my answer is, I don't know. I don't know. But when we do, then you react. Does that make sense? And the people trying to read order flow, you got to recognize the important orders. You got to know the right questions to ask. And then it's going to really make your timing better. There was another example. When they got through it this time, they ran through it. Never came back. So there's nothing wrong with getting long here. There's something wrong with staying long for a full stop, or certainly you're not even admitting you're wrong until down in here. You got to know where you're going to get out before you get in. And I had someone ask, what kind of risk do you take on this trade or that trade? It varies. And what your initial risk doesn't have to be your eventual risk. So if you're looking to risk maybe 4 to 6 ticks, which is a point and a half, and you get in right there, and it goes up your way a little bit and it comes down, maybe you're not risking 4 or 6 anymore. You're just going to scratch it. Your initial risk doesn't have to be your average risk, is the point. You do want to give certain trades room to breathe, and that's a decent sweet spot. If it's more volatile, you got to give it more room to breathe sometimes. And that's where I tell people, cut your size because you have no choice, because you're going to have to increase your risk based on having wider stops. So don't get stuck in to having the same standardized risk tolerance every single day in and day out, because the periods of volatility change. So you adjust your risk by adjusting your size that you're committing. And don't put too much thought into always trying to predict. Be better at reacting. Trade what you see, not what you think. I want people to remember that as we head into the weekend. Trade what you see, not what you think. The training that you've done solidifies what you think. You've already thought it. Now you see it and you react to it. That's when you have proper training. If you're doing too much thought about what could happen, stop doing it. There's a saying, I remember a guy in the room brought this up a while ago. He says, if you got to look for a trade, once you find it, don't take it. If you're looking for a trade, once you find it, don't take it. Because you'll always find a reason to get long, get short. Your mind wants to get you involved. You want that proverbial hand to come out of your screen and slap you in the head saying, hey, if you're bearish, get your ass short there. If you're long, get your ass out there, and then be consistent. Have a safe weekend. Subscribe, notify.